freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, what is up today?
Well, for listeners who have been following along on the probably convoluted timeline of the flip that I did, because I don't know what order these episodes air in, we are now done with it. So that's because that was my morning. I was at Home Depot at 5:30 in the morning, and then at the flip at 6:30, and by 8:30 I was out of there. It was all clean, and maybe we could make that. No, wait, this is an interview. I was gonna say we could make that the cover photo of the episode, but that would be silly.
Your flip.
Yeah.
It looks nice. You were showing me the photos earlier. It's turned out really well, especially considering what it came from. I don't know if we can toss a before or after photo link somewhere in the description or something like that.
That might be a fun episode to do at some point, is talk through just what the economics were there, how to structure a deal, because I had a third party, I had a money partner on it, and that's an infinite return, right? I mean, time, but there's an infinite return. So
all right, we'll
talk through something like that.
We'll do that, especially because you had it staged today and you're getting photos tomorrow, correct?
Stage today, photos tomorrow, so today's Tuesday, should be listed by Friday.
Okay. Well, we'll definitely do a future episode on that, show some photos, and I think it'd make a great fun case study. It's really good. Well, for today's episode, I'm excited about it because we got a guest.
Yeah, Steve, who we knew from our days in the mastermind group we were all a part of, SMC, Syndication Mentoring Club. It's where me and Dustin met and then kind of turned into the collective after a little while, but known Steve for a long time. He is big in kind of the commercial real estate. Strip malls is what it is, right? So it's not going to be
retail.
There he is. But he does a little bit of medical. I think of it as commercial buildings, right? But not. So it's retail, but it's small retail. I think mainly what we would think of as strip malls. And so really excited to kind of hear what he sees in that market space. He comes from a different background. He has, some housing, did some development, and just being able to hear his take on where the market's at, how things are going, and really why he likes that space so much compared to all the other facets and avenues of real estate out there.
Yeah, no, I'm excited about it because I think we are obviously more residential and apartment focused, and I think we've had several guests that have been that way, and Steve's not. This is a different space, and admittedly, retail and kind of the triple net space, that's not something that I know a ton about. So Steve's an expert. He's been doing it for a while, and excited to dive into the interview with him. So awesome. Without further ado, let's jump into it. All right, Steve, welcome to the show.
Thank you. Great to be here.
I'm interested to hear a little bit about your background. Maybe introduce yourself to our listeners, just high level, what you do.
Yeah, absolutely. I spent a time for a cup of coffee in the corporate world, and then got into entrepreneurship early in my career, and built housing developments, mostly in closely held partnerships for quite a while. Like most people, ran into the buzzsaw of '08. Was grateful and blessed to make my way through there, but not without some battle scars, and kind of decided that I didn't want to do ground up tract development fully going forward, and transitioned to doing cash flowing properties starting around that period, right around when I went back for my MBA, and tried to pair real estate and finance together and make good investments. That's what I've been working on ever since. So,
and you've kind of pivoted right to the strip malls type of asset and finding a good tenant base and not having to deal with the residential side of things. Is that correct?
Yeah, it is. As common knowledge, the multifamily market got pretty overheated in the late teens and early 20s. And as we were out looking for yield, we just really don't like to chase marginal deals and fight over those deals with other people. So we broadened our horizons a bit and started focusing on multi-tenanted retail and medical. And then we started looking for markets outside of our backyard as well as part of the same strategy, just to add more alpha for our investors.
What's the, a lot of our listeners are familiar with a rental, right? And that's kind of when you start in the real estate investing career, you're going to start with, hey, I'm going to buy a rental house, or at least it's familiar to you. And then, okay, there's apartment buildings. That makes sense. I've lived in one of those, and there's just a lot of tiny houses put together. But a strip mall is a totally different thing, right? You've got businesses sitting inside of it. How does your underwriting or kind of overview of those deals differ when you went from, you said you learned some things in the '08 crash to now, working with a business where you have other businesses inside of it, not that you run, but that they have to be successful for your property to do. Can you talk a little bit about that?
Absolutely. So you're right. It is very different. There's pros and cons. I think there's a lot of things that scare off maybe the average person when they drive down the street and they're looking at a strip mall. It looks like there's a lot going on, or maybe they see vacancy and that scares them. But I've just kind of learned to embrace that. I think there's a couple of things if you're going to be in strip malls or in medical or any other, commercial aspect that you need to love. And one of them is you need to love understanding the underlying business of the people who are in there. And from my perspective, I like national tenants, but I really like local entrepreneurs, especially ones that have already been on their third or fourth store. And I just love to hear their stories. It inspires me. And I think you kind of need to love to put that lens on and start to see a property through their eyes and try to put together the whole piece. The other aspect I think is very different in a positive way is that people don't realize that when you have an apartment and I go in and I buy an apartment building, I'm typically rehabbing the space. In my spaces, it's the tenant who's using their money and their expertise to set up the space the way they want. And in many cases, we have something that's called triple net leases, which simply means that the tenant is actually responsible for all of the expenses. It means net of taxes, insurance, and common area maintenance. And so in many of the cases, it's a modified version of that. But some of the cases, they just take care of absolutely everything. So there's no calls for air conditioning, anything else. And even if the air conditioners completely fail, in many cases, they're responsible for fully replacing them. So that's something I think that's very different and people don't realize. And also, I think the leases are longer. So sometimes it's harder to secure a really good tenant and find the right fit. But I have a tenant in one of my spaces in my New Jersey properties who's they've been there since 1986. So 3% increases every year plus triple net factors just kind of growing over time, right? So some of them leave. Sometimes you have a dark store, but overall those type of things even out. You just gotta. And I think your growth rate tends to be a little higher as well, but your the variation might vary a little bit more than self-storage or multifamily, where you have, maybe 50 or 100 tenants. I might have 7 to 20 tenants. So one of them goes out. Yes, I'll have some vacancy, but you leave enough capital aside to deal with that.
I think one thing that I want to dive into a little bit around the vacancy in your tenant base is, right, when you think about a commercial building, some people might first think about office, which has been not the best asset recently, right? Because everyone's kind of moving to that work from home environment, or there's just less spaces in the office. Companies are downsizing. AI might be a risk on some of that. Your tenant base is very different though, right? You're looking for medical professional things like that. Can you talk a little bit about what your tenant base is that you look for that kind of lets someone be in there since 1986?
Sure. So that I would say to describe the ones in that 1986 center is we would describe as neighborhood center in the shopping center world. So stuff that services the last 2 miles from home, very Amazon proof. It's your pizzeria, your tailor shop, those type of tenants. We've got a sushi restaurant that's takeout only in there. So very resilient during COVID, very resilient afterwards. So that's pretty much the tenant mix in there. We don't like big box stuff. So no Best Buy, no JC Penney's, no, any of that stuff. But things, I think we learned in COVID that even though they were pitching it, most people don't want their latte delivered, by a drone to their backyard. Right. So we want to actually go in and see.
Too much of the milk spills out.
Yeah. And, they locked us away in caves, whether you were for that, against that. And, you realize, everybody realized you want to go see some people in your neighborhood sooner or later.
Yep.
Right? This is the blowback once everybody got out from that situation was that we were going to, be able to go out and see people that we interact with at least locally. So even though so much of the clothing in that has kind of maybe gone online, I think the rest of the retail is here to stay, and it'll just continue to evolve and grow where people live. So.
You always need to go down to the local corner store to get a slice of pizza. I know that'll never go away. So where do you see, and maybe you answered it there, but where do you see this space going for the next 10 years? Is it just the same type of businesses that we already know and expect to be in there? Your light medical, your pizza shops, your laundromats, whatever those may be?
Yeah, I think it continues to evolve, but it's been continuing to get much more experiential. So it's yoga, it's everything that you don't really want to do online, right? Getting your hair cut, you might try it online, but it doesn't work too well. And your pizza, your sushi. We see some of the lighter medical, like I said, even larger medical is for the first time really trying to get a footprint in the retail space. And we see a lot of hospitals coming to us, hospital auxiliaries, where they might have a big, ugly hospital built in the 80s and 90s. Instead of redoing the whole thing, they feel like they want a presence out in the community for certain services. And it kind of pairs well. I feel like the medical often becomes the new anchor for the retail center, where once they get in there, they want to stay. They want a long-term lease. If you treat them fairly, you treat them properly, they want to be there. And if there's somebody who has a lot of new customers every day, that works great for the pizza and the Ace Hardware and the Planet Fitness as well, right? So there's a complementary business model there. I think that was just missed, or maybe we just evolved into it as far as the way we do retail. And the other point I would make with that, Adam, is that so many, we see this right now in office. Nobody's building office, right? And going into 2021, really, nobody was building any retail anywhere because everybody was telling us that, no one's ever going to the store again and yada, yada, right? So it takes a long time to onboard and get stuff approved and all of that. So there's really an undersupply of a lot of these things. Retail had its best year ever in 2024. So it's not really what the hype says everywhere else. It's just different than it was 10 years ago.
Steve, you touched on something there about the medical, and I think I first heard this term from you. The Medtail is kind of what you'll refer to it as, and I'd love to hear a little bit more about that. And like you mentioned that was something either was new or was missed or something, but I don't know. That's a new thing, and I know that's a little bit of a focus of yours. So I'm just curious if you could elaborate a little bit more on that and kind of how that fits into your investment thesis.
Absolutely. So we have several centers that I would consider a Medtail, and I've got a couple that I'm working on right now. And obviously, if you use the term Medtail, you're going to lose in Scrabble, so don't do it. But it's really just combining those two things and finding the right appropriation. So the way I would define it personally is if you have a mostly medical suite center and you see, one ice cream shop or Edward Jones in there, I would just call that a medical center. And the same thing vice versa, right? So if you had something mostly retail, but when it's intentional and maybe you get 40% medical and 60% retail, and you're trying to set up a whole center that just serves that 2 to 5 mile neighborhood, I think that's what really becomes Medtail for us and becomes attractive because, like I said, you can kind of go after maybe higher or trendier concepts with some of your retail because you're really anchored with some of those long-term tenants with the medical who are able to finance everything you want to do there. And they really don't want to leave. I do have a truly medical center as well with 20 suites in it. And I've had it for 5 years, and there might have been 2 suites that turned over, right? So we've been able to, raise rents, and obviously we do some stuff for them as far as when they're turning over their leases and that to keep them happy. But if you have a dentist shop and you branded everybody coming to that center, as long as the landlord can kind of keep things updated and that type of thing, your bias is to stay, not to leave. So I really love that component of the local retail.
Gotcha. Do those the medical tenants, is that primarily doctors, dentists, things like that, people performing medical services, or do you also look to more like medical retail, like pharmacies or something like that?
I don't currently have any pharmacies, but yeah, you're right. Doctors, pharmacies. Doctors, dentists. A lot of physical therapy. The thing with the another thing I should have mentioned with commercial is a lot of the leases are actually guaranteed by credit tenants. And so some of our tenants, even on their credit, or the group that backs them, whoever owns that group is actually guaranteeing the lease for a period of time, especially if they ask for anything from the landlord up front, right? So if they ask for some free rent while they fit out the space or some tenant improvement allowance, usually what you get back in exchange for that is a guarantee by either an individual or the corporation, right? So that's what makes the financing of commercial real estate like this work a lot better, right? The banks like that. And I think the banks really like Medtail a lot, to be honest with you. I think they're getting more familiar with it. A lot of times they really, kind of turned their noses up at centers that were all local retail. And they would get over fascinated with a center that had maybe a Starbucks or something like that in it. But I think that's another thing that 2020 taught us is some of those companies were the first ones to bail out on their leases and get big legal teams to try to, minimize their damage in a space. And, the mom and pop stores that have their entire life savings in there, they tried to, in most cases, to try to eke it out and forge through. So I'd like to keep them, but I want to keep the bank happy. So having medical and some nationals in there, it's kind of a nice balance. And it's just trying to figure out that right puzzle, the right way to put it together.
So I'd like to kind of take a step back to something you said earlier, and then Dustin, if you got questions after that, feel free to jump in. But you said that you were doing some housing developments, took a bath in '08, kind of like a lot of people. And what lessons did you learn from that? And then the second kind of part of that question is, you talk to some people and they're like, everything's great today. And you talk to some people, they're like, I see '08 all over again. And I'd like to know which one's right. So if you could tell me, that would be great. But, what lessons did you learn, and how does some of those lessons or the things you saw during that time compare to what you're seeing today in our market?
Yeah. So things were going probably better than maybe they should have or could have from 2000 to 2007, obviously, right? So maybe we had that in the teens. For me, it was just, when something like that happens, you want to have cash on hand, have cash flowing assets, and be able to get very creative and work very hard, right? So, like I said, we had housing. We were under contract to sell out a large development, and it was contingent on us putting another set of roads in that I and others had to sign on the debt for, and then the large home builder backed out, and so. It was just time to kind of roll up the sleeves and get creative. So we came up with a kind of a certified pre-owned townhome program where you could turn in your townhome east of ours as long as you paid market price or development, and we go rehab the townhome, rent it out, and kind of keep our development moving that way. So it took 4 or 5 years to slog along that way, but everybody did pretty good on the back end eventually, and didn't go as high as the highest numbers, but made it through. And I think that to me is the lesson: is find a way, right? Entrepreneurs find a way. That's what you need to do. And I think it would have been a lot easier if I was in cash flowing assets to do that. So I wouldn't have had to tighten the belt as much. So
I think that's an interesting point you made there, especially in just hearing the unique way that you kind of pulled yourself out of that situation, because it shows all the versatility in real estate, right? It's not, and I don't know if this is the best comparison, but if you were in stocks and the market tanked, you're kind of like, well, it tanked. I guess I get to sit here low. If I'm leveraged, I get margin called and my account's at zero. But you were able to create a really unique opportunity and kind of pull yourself through that. So I think that just to our viewers, that's one of those benefits that you see in real estate that is you don't see in a whole lot of other things. And to your point, and me and Dustin talk about this a lot, if you're buying cash flowing assets, you can do a lot to, you can weather a lot of storms with the cash flow coming off of those.
Steve, I've got a question. I know we're kind of bouncing around on topics here, but thinking about your sort of buy box, I know you and I've talked about this a little bit before, but I just love for you to share more about kind of what it is that you look for, the markets you look for. I know you look at you're very specific about the markets that you want to be buying in, and kind what your overall business plan is when you're looking to acquire. And I know you do a lot, and you're sort of opportunistic in some of the things that you buy, but we'd just love to hear a little bit more about what you're looking for, the markets that you're in, what's special about those markets, things like that. Yeah.
So specifically, I try to find markets where there's a growth rate better than the market that I'm in or the investors are from, just to give a nice tailwind to whatever I'm doing, right? So that's a general thesis. Specifically right now, what I'm doing is buying in port cities. And they got to be secondary or tertiary cities on their path becoming primary and secondary cities. Some examples of those would be Mobile, Alabama, Savannah, Georgia, Charleston, South Carolina, even Norfolk, Virginia. So what the thesis behind that is these cities have all had or are in the process of having major infrastructure that's been spent by national infrastructure projects that take a long time to onboard, but also have like a 10 to 15 year period where they're coming to fruition and you're kind of reaping the benefits through the whole market of that. So one specific example would be Savannah, Georgia was depending if you based it on TEUs, which stands for 20-foot equivalent units, or in tonnage, they were the 8th or 9th largest port in the country in 2020. And now they are a third in TEUs, right behind New York and LA, right? So they only have 330,000 people, but they're the third biggest port all of a sudden, right? So one thing that's happened there where they've taken advantage of that is they just brought a new Hyundai electric plant in there that just onboarded in 2024. They brought 15,000 workers from outside the market into the market just for that. And they only had 90,000 people in their workforce before that, right? So that just, when you go visit Savannah right now, there's cranes everywhere, there's things going on, there's new retail that's needed, there's housing that's needed, right? So, and those things can get overshot if people get too excited and built. So you got to kind of watch the ebb and flow, but you now have a nice tailwind where some of the normal junk that happens in real estate, you kind of have something to kind of carry you through and the whole market moving in the right direction for you. So when you compare that to where I'm at in New Jersey, it's had those kind of growth spurts before. No jokes about New Jersey, Adam. But right now it's a mature state that is, just kind of mature and staying there. And there's a lot of money chasing the same properties. So it's hard to find, extra yield, right? So there's a lot of people just in finance and that they buy properties near their house, and you just can't find stuff where it's got extra alpha or extra return.
That makes sense. Within those markets, so like taking Savannah as an example, do you look in, like, I'm assuming you're kind of going more to the suburbs because that's where typically these centers would be, correct? Like, is there a certain radius out that you won't go further than, or like within a market, like what are you looking for in sort of submarkets, or like what would make a great place to buy?
Yeah. So I think the biggest reason you just hit on it to have a pretty tight buy philosophy is that we all want to chase yield, but you don't want to chase it off a cliff. And what layer of the suburbs is that proverbial cliff, right? So that's, we like to be inside. That's another reason I like port cities, right? Is the growth is limited on one side by the port or the ocean, sometimes a river on one side and an ocean on the other side. And it just gets non-economical once you get usually outside the first or second major highway they cut through to have that kind of contained growth. The sprawl beyond that gets chaotic and hard to predict. So that would be my general criteria. I typically don't like, other people like stuff downtowns. The reason I don't like, and in a city like Savannah, is a lot of it is short-term rentals that are owned by corporations. So they're not private short-term rentals. Somebody's come in and they own, 30 of the top floors because they set a section that you're allowed to do short-term rental in other areas that aren't. So once that gets institutionalized, stuff just starts to trade at numbers that really only make sense if you're wrapping up a lot of stuff in your Blackstone or whoever. But individuals do go buy stuff there, maybe retail on the first floor, a couple floors of single tenant, if they're going to go be an owner operator of the property, or if it's just kind of that mixed I really love a place when I go on vacation, and I like that it's paying off my mortgage. But that's really kind of not an investment the way I look at investments, right? So I'm trying to make money for other people, and that kind of dynamic doesn't work for that, right? So,
sure. That's actually a great lead into my next question, which is thinking from the point of view of a passive investor. So a lot of our audience is somewhat familiar with passive investing and syndications, but especially because of mine and Adam's focus, a lot of times that's within apartments or more of a residential nature. Is kind of Adam's question earlier. This is retail's a little bit of a different beast. So my question is, if I'm a new passive investor, have never invested in anything retail, I've only ever looked, I've never invested in this space, period, or I've only ever invested in, say, apartments or short-term rentals, self-storage, something like that. Like, what are the things that I need to be aware of if someone brings me a retail deal? What I need to be looking for? What kind of is the same? What's different? What do I need to be on the watch out for as a passive investor?
I definitely think that you should be looking for somebody with experience with retail if you're on the passive side. If you were on the active side, I'd say, wade in slowly with maybe a mixed use or something like that, right? Where you have the comfort of maybe multi and then, maybe one store or two stores, and you can kind of get used to it that way. But if we're focusing on passive investors, there's a lot that goes into it. And I think that your ability to kind of match proper retail tenants with other retail tenants is a little bit of an art form that you got to get used to. So I think track record becomes very important, just making sure that somebody's actually done that. Then you want to make sure that they are aware of, they're paying attention and expressing to you how long the tenants are in there for, what type of guarantees are in place. Make sure that there's no short-term debt, right? Because these tenants, you usually have a schedule that they roll off at different times, and you don't want a situation where there's 5 tenants on a 5-year and they all expire in the same 5th year, right? So, and there's ways to mitigate that. Like, if you know what you're doing, you come in and you see that, you buy it, and you go to somebody right away and get an extension, right? Maybe you offer them something. So there's things that somebody who knows what they're doing can start to mitigate the risk and kind of make it more uniform. But I probably would not invest in somebody if there was a first retail deal. I'd let them do that with their own money. So
sure, I think that's good advice for anybody, right? Like, comes back to track record. So much of that's important, to being able to trust on someone else's expertise to kind of know those things to look out for. But that's really good. And that's just me. I mean, I've never invested in a retail deal. So like, some of this is my own curiosity, right? Like knowing what to look for and the different leases. And it's different from like what I'm used to looking at. And I know there's an entirely different set of, concerns and things you got to watch out for.
Yeah. That's, I could give you an example of when you're dealing with a national tenant, something that's totally different is you're expected to put some money up in those cases, right? So, say Starbucks comes to you and or Panera, and they want you have a white box, they want to fill it in, and so they might make a 10 or a 15-year corporate guaranteed lease to you, and that's very valuable to you because your property will now trade at a lower cap rate, which the banks like, and also it just gives the rest of your tenants will fall right in behind there. They want to be there because that tenant is there. So you might have to go to the bank or come out of cash and maybe you cut a check to them, just for example's sake, for $100,000 or $150,000. And so if you're new to this, you'd say, well, that's crazy, right? But they'll often give you a much higher rate in return for that. And then they turn around and they'll sink their own $500 million into your space in 2 seconds. It's much more of a test to see if you're, from my perspective, it's much more of a test to see if you're in line with them, if you're capable of taking care of the center, and that you've got skin in the game as a landlord. So it's just structured that way. You can't really get out of it. And if they really want to be in your space and you don't want to give them any free rent or anything on the end, you'll end up with a really low lease rate, which really devalues your property. So you should be prepared to have some dry powder or access to it. So when good opportunities like that come along, you can take advantage of them, right? So that would be I do have a confession to make. I am actively looking at office property, Adam.
Oh,
and I'm fully intending to go into straight office. So,
Well,
but
everyone seems to hate it. It might be a great time.
I think so. So,
yeah.
But I think it goes to to the same thing that we're talking about is everything gets thrown out with the kitchen sink, right? So, all office bad. I always call it like caveman economics, right? And that's unfortunately how the big banks think, right? It's like all retail bad, all office bad, all whatever, right? But if you're in the right market, you look at some of these markets I'm talking about, they don't have enough office. They never did. They were tourism destinations. Someone came in and put a port in. Now all these businesses are moving there and there's zero office and no one's got any permits, right? So if you own an office there, you've got 30 people knocking on your door and you told to go over to the bank and they go, well, I don't like office, right? So if you can find a way to figure out the capital structure and get deals done in any asset type that's kind of out of favor a little bit, I think that's often where you can, really do well. And that's what we plan to do with the ones that we're looking at right now. So
I think that's so good. I mean, that's something I talk about often. I actually wrote about it in the newsletter, I think this past week, about supply and demand, right? And ultimately that's what you can get complicated with all sorts of things, but so much of it comes back to supply and demand. And if you get that right, there's a whole lot else you can get wrong and still be okay. And so I think that's a great example that office is really hated right now. And you get a lot of people that think that's a bad investment, but that there's still demand for it. Like if you can find pockets where there's demand and it's undersupplied, then it's a great time to be buying, especially if the rest of the world thinks that it's terrible and there's, a scarce, a dearth of buyers. So yeah, I mean, I think that's a great reminder. Like don't just, don't rely on as you said, the caveman economics. I think it's a great phrase.
Thank you.
Adam, you got any other questions?
No, nothing else on my list here. You can wrap it up if you want.
Well, Steve, we always like to ask all of our guests, we're the Wealth Independence podcast. And so, wealth and independence and freedom, and those are important words to us. And so we always like to ask our guests, what do those words mean to you and sort of how do you manifest that in your everyday life?
I think there's a lot of people these days that they talk about freedom and they start referring to it as like freedom from work is some kind of nirvana situation, right? So I think the complete opposite. I think we were designed to work. We were designed to pursue excellence. We were designed to, pursue other things. And it doesn't have to be work in a traditional sense, but if you want to make yourself miserable, just do nothing, right? And so I like to think of freedom as the freedom to work on what we want, how we want, when we want, and with who we want. And I think that is a big driver for what you guys do and I do is we want to help other people be able to do that through passive investments. Yeah. And a lot of times if you're, at a W-2 or you feel like you're in the rat race, you might love what you're doing. Maybe you went into nursing and you love nursing and somebody says, oh, why are you, why don't you quit that and go do real estate or something like that? And you're like, well, that's crazy, right? Because this is what I feel like I'm supposed to be doing. And that's not really what we're talking about. We're talking about, hey, listen, if you have extra income coming in, you might be able to choose to stay longer at a certain job that you really love and maybe you bypass a promotion because you don't have to take it. Maybe you can choose to do it in a consulting fashion or a different city that you wanted to, or stop earlier, or what. There's lots of things that we can get freedom within our work to do it more on our terms and with more liberty and dignity, quite frankly, when we have other passive income coming in that can support us and help us pursue those freedoms.
Well, Steve, we appreciate you being here with us today. I guess if folks want to connect with you, they want to learn more about the deals you're doing, what's the best way for them to get in contact with you?
SageSquareCapital.com. And or you can reach me on LinkedIn at Steven Salvigsen at LinkedIn.
Okay. That'll be great. We'll make sure to throw both those links in the release notes and everybody can click. But Steve, again, we appreciate it. And thanks for your time.
Thank you guys so much. Loved it.
Okay. Well, that was great. We definitely learned a lot about retail space and things that I didn't know. Some of I had a whole page of notes here that I wrote down different things and kind of expanded on questions I had. Was there anything that you took away from that, Dustin, that you want to recap?
I thought it was great. Like I said in the intro, I was looking forward to it. I've talked with Steve a lot. You mentioned you and I both spent a lot of time with him, and it's an interest. The whole retail and Medtail. I think he's got kind of an interesting angle on some things there, and it's fascinating to me because it's not something I know a lot about. And Steve's had a lot of success, and I think he's seen a lot of deals. I know he's told me before he's a deal junkie, and so he's done a lot of stuff and has a lot of experience. And I think we really, even just this short time we had here today, was just kind of scratching the surface with him. So there's a lot. I mean, I think it's an interesting place. I think it's something that could be complementary for a lot of people from like a passive investing standpoint. Something that's really, I think a lot of these deals can tend to be non-correlated to some things in the apartment space, and not that like that's good or bad, but it's a kind of a way to hedge the portfolio a little bit and have some different type of deal exposure. I think something that is interesting, he mentioned the difference in lease lengths, right? And you're signing longer leases. The residential space is almost always 12 months or shorter, and there's some pros and some cons to that. He talked a little bit about some rent increases, and you work those into the lease, but then also how kind of staggering that can help ensure you don't end up with a bunch of leases expiring at the same time, and now you got the whole place going vacant. And so there's just some unique angles there. I'm definitely overall bullish on medical in general, and I think that sort of that Medtail kind of space I think it's going to be a really, really good place to be going forward. We've got a lot of people we got the boomers getting old, and there's not enough doctors' offices to kind of take care of them as they age into that. So I think the next decade is going to be really big for this space. And I think Steve's got a really, kind of different way of playing it, where it's not just a pure medical office play, but there's also retail and, taking advantage of having foot traffic in the same place, and then other tenants that can, benefit from that.
One thing that I got from it, and it's a little less specific, but when he was talking about turning that house in development and doing the certified pre-owned condos and things of that nature, it showed me that he, when things got rough, he didn't just crawl under a rock, right? I mean, he is an entrepreneur through and through, and I think that's really what you need in this space, right? I think so much of our world, as most people know it, and the economy and jobs out of college are just, you do a thing, you're done at 5 and you go home, right? But that's not what being in business is about. And then, passive investors have the ability to kind of just say, peace out, whatever, here's my money. But you also are having to hand it to someone that hopefully does that. And as we talked about a little bit in the intro to this, I was up early this morning going and buying stuff to finish off a house flip, right? And there's nothing crazy going wrong with that, but timelines need to get met, things need to get done. And I think Steve really kind of embodied that, or I just get it done type of mentality. Yeah.
And something else he said in that same, that same part, I don't know if you picked up on it, but he talked about the importance of having cash in, when times are tougher. And we've had several guests that have made that same comment. So it's kind of interesting to see that.
Well, he said cash flow.
Yeah. Cash or cash flow, right? I mean, it's kind of.
Well, sure, but you could just have, once again, I'll tie back to a flip. A flip isn't a cash flowing deal, right? You're betting on appreciation or building appreciation versus buying something like what we buy, our oil deals or short-term rentals or any of those. They produce income every month.
Yeah, exactly. No, I think this was great. Like we said, we'll drop Steve's contact info and website, his LinkedIn. We'll drop that in the show notes. Be sure to check it out. Connect with him. I know he's always happy to jump on a call with folks and have a conversation. He's a fun guy to talk to. So definitely take advantage of that and connect with him. But I think that's all we got. Adam, you have anything else?
Nope.
All right, we'll get on out of here. Everybody, thanks again. We appreciate you joining and listening in this week. We will catch you on the next one. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.